You see it everywhere, right? The headlines are practically screaming about a recession. But what if the real story, what if the most important clues are actually being told in whispers? Well, today we're going to become economic detectives. We're going to search for those quiet clues that show us what's really happening. So let's start our investigation.
So let's start with this. This is going to be our guiding principle. See, every major downturn leaves behind a trail of evidence, and our job is simply to follow that trail, not with panic, but with a clear head. This is all about strategy, not stress.
That's the big question, isn't it? How do we actually do that? Well, over the next few minutes, we're going to build a toolkit. It's designed to help you separate the real signal from all that noise. We'll look at the exact indicators the pros use to gauge the economy's true health.
You have to remember this. Fear is loud. Data is quiet. The loudest voices you hear, they're usually selling panic. The most valuable information, well, it often whispers. Our job is to learn how to listen.
All right, so our investigation begins in the financial markets. This is where the really big money places its bets on the future, and their collective wisdom, that can give us our first incredibly powerful clues about what might be coming next.
Okay, I know this sounds super technical, but the idea is actually pretty simple. Normally you get paid more to lock your money up for a longer period of time, right? Well, an inversion is when that whole thing flips on its head. You actually get paid more for a 2-year bond than a 10-year bond. It's the market's weird way of saying, something's not quite right up ahead.
And this has a direct impact on the real world, on you and me. Think about it. Banks make their money by borrowing short-term at low rates and lending long-term at higher rates. When that curve inverts, their whole profit model gets squeezed. And when that happens, banks get nervous and become less willing to lend money. And that can slow down the entire economy.
So it's not just that the curve inverts, it's how it inverts. A brief, really shallow dip, that could just be a false alarm. But a deep, persistent inversion, especially when you see banks starting to tighten credit at the same time, now that is a very serious signal.
Here we go, our next clue. I want you to think of this as the market's anxiety meter for lending money to companies. When anxiety is low, the extra interest investors demand is pretty small. But when they get nervous, they demand a much higher payout for taking on that extra risk.
Just think about it this way. If companies, especially the weaker ones, suddenly can't borrow money on the cheap, they can't invest, they can't hire new people, they might even struggle just to stay afloat. This is exactly why they say credit is the lifeblood of the economy.
So a widening spread is basically a direct vote of no confidence from the credit markets. It's a huge warning sign that corporate defaults could be on the rise, a clear signal of stress building up just beneath the surface, and it often happens before the stock market fully reacts.
Okay, so the financial markets are definitely giving us some clues. But what's actually happening on Main Street? Let's shift our focus now to the real economy. You know, the businesses and the households that drive this whole thing.
The stock market can get driven by a lot of hype and hope, but eventually everything, I mean everything, comes down to this one question. Are companies actually making money? Corporate earnings are the ultimate reality check for the economy. And we're not just looking at past results here. We're looking for a pattern. Are companies consistently warning about the future? Are their profit margins shrinking? You have to listen to what the executives are saying on their earnings calls. That cautious language is a dead giveaway. And watch where the smart money is going. A big shift to defensive sectors, things like utilities or groceries, stuff people need no matter what. That's a major red flag.
Okay, this is a super common trap, so listen up. The media loves to focus on the unemployment rate, but that number just tells you where we've been. What you really want to watch is the number of people filing for unemployment for the very first time. That's initial jobless claims. That tells you where we're going. It's a forward-looking signal that businesses are starting to cut back right now.
At the end of the day, the entire economy really rests on the consumer. If households aren't financially healthy, the economy just can't be. A recession often begins quietly, right at the kitchen table, long before it ever makes the headlines.
These are the vital signs of the consumer. Are more people falling behind on their credit card bills? Are they saving less and less money? And when you start to see spending shift away from things like vacations and gadgets and toward just the basics like groceries and gas, that's a powerful sign that households are battening down the hatches.
So we've gathered our clues. We've looked at the financial markets. We've looked at the real economy. Now comes the most important part of our investigation, putting all the pieces together to see the full picture.
And this is maybe the most important takeaway of all. No single clue solves the case. A yield curve inversion on its own, it isn't a guarantee. A bad month of retail sales could just be a blip. The real power comes from confirmation, when all these different independent signals start telling the exact same story of a slowdown.
So here's how these clues usually connect. First, you see stress appear in the financial system. Then corporations see that and they react with caution. Finally, that caution trickles down to households, usually through the job market. When you see these dominoes fall in that order, the case for a recession gets very, very strong.
Okay, we've analyzed the signals. So now what? What do we actually do about it? This isn't about panicking. It's about having a clear, rational plan in place before you need it. So let's walk through that.
Look, nobody can time the market perfectly, and honestly, trying is a fool's game. The whole goal of watching these signals is to give yourself time to prepare your portfolio for some rougher weather, not to sell everything at the exact top. Here's a simple 3-step framework. First, know what you own. Companies with a ton of debt are the most vulnerable. Second, check your allocation. Maybe consider shifting a bit towards businesses that are essential no matter what the economic weather is like. And third, keep some cash on hand. Not to hide, but to be ready to seize opportunities when great assets go on sale.
And this right here is the final crucial mindset shift. If you start seeing recessions as just a regular, even predictable, part of the economic weather, they become a lot less scary. They are the events that wash out the excesses and create the incredible buying opportunities that build long-term wealth. The economic cycle will always turn. Another downturn? Well, it's inevitable. So the only real question is, will you be ready for it? By learning to listen to these quiet signals, you can act with discipline, not emotion. You can be prepared, not panicked. So the choice is yours. Are you going to listen to the noise, or are you going to listen to the numbers?